In this video, we are going to learn two important financial terms, return on equity and return on capital employed, best known as ROE and ROCE. These are the important parameters in the analysis of business of any company. Let us discuss first ROE, that is return on equity. ROE is expressed in percentage. It shows net income of any company returned to shareholders. That means by knowing ROE of any company, a shareholder of that company can predict the expected return of their investment. Hence, we can say it is a tool for the investors to measure the expected return from their investments in the company. Now, how to calculate return on equity of any company? So, it can be calculated by the ratio of net income of the company to the shareholders' equity. Let us see importance of ROE. It gives an idea how well a company uses shareholders' money to produce profits. Let's take an example to understand it. Suppose a company's ROE is 20%. That means if an investor has invested 100 rupees in that company, by using that 100 rupees, the company is making 20 rupees as profit. Now, let us learn ROCE, that is return on capital employed. ROCE is also expressed in percentage. The fundamental difference between ROCE and ROE is ROE considers profits generated on shareholders' equity, but ROCE is the primary measure of how efficiently a company utilizes all available capital to generate additional profits. ROCE considers loan taken by the company and other liabilities as well. Capital employed can be calculated by total assets minus current liabilities. Hence, ROCE can be calculated by the ratio of earnings before interest and taxes to the capital employed, that is total assets minus current liabilities. To better understand the ROE and ROCE and the difference between the two, let us take an example. Suppose ROE of a company is 20% and ROCE is 35%. If the average ROE of different companies of the same sector is less than 20%, that means this company is giving good return to the investor. And if the average ROCE of the different companies from the same sector is less than 35%, that means this company is doing the business very well. One more thing is here to notice, that the ROCE is more than the ROE. So, from this, one can conclude that the company has made intelligent use of debt to reduce its overall cost of capital and enhance its return. But at the same time, one can take it as negative with an argument that the loan providers, that is debt holders, are earning higher than the shareholders. The conclusion is ROE is more important from the point of view of the shareholders, and ROCE is important to understand the business as a whole. Thank you for watching. I hope you like this video. If so, please do subscribe this channel for more such contents, and also comment on which topic you want the next video.